Imagine you're 18 years old. You've just graduated, you're holding your college acceptance letter in one hand and a student loan offer in the other. One feels like opportunity, the other feels like a quiet promise you don't fully understand yet. Today we're talking about student loans, what you really need to know, focusing on both Australia and the United States, because depending on where you live, student debt can either feel manageable or completely overwhelming. And if you're a student, a parent, or just planning your future, this video might save you years of stress. Let's start with the United States. In the U.S., student loans are a massive issue. Americans collectively owe over $1.7 trillion in student loan debt. Yes, trillion. That's more than credit card debt in the country. The average federal student loan borrower graduates with around $30,000 in debt, and many owe much more, especially if they attend private universities or go to graduate school. Here's how it works in simple terms. In the U.S., students can take federal loans from the government or private loans from banks and lenders. Federal loans usually have fixed interest rates and more flexible repayment options. Private loans often have higher interest rates and fewer protections. Interest is where things start to get serious. Most U.S. federal undergraduate loans currently carry interest rates around 5 to 7% depending on the year. That interest starts accruing, meaning growing, and over time it can add thousands of dollars to what you repay. If you borrow $30,000, you might end up paying $40,000 or more over time. Repayment usually starts 6 months after graduation, and here's the key difference. In the U.S., you must make monthly payments regardless of your income, unless you qualify for income-driven repayment plans. If you lose your job or earn very little, you still owe that money. Defaulting, meaning failing to repay, can damage your credit score, lead to wage garnishment, and even affect tax refunds. Now, let's compare that to Australia. Australia has a completely different system called HECS HELP. Instead of traditional student loans, eligible students can defer their tuition fees and repay them through the tax system once they earn above a certain income threshold. This is where it gets interesting. In Australia, you do not pay anything up front if you use HECS HELP. The government pays your university directly, and your debt is recorded with the Australian Taxation Office. Repayments only begin once you earn above a minimum income, currently around the mid-$50,000 AUD range per year. If you earn less than that, you pay nothing. And payments aren't fixed monthly bills. Instead, a percentage of your income, starting at around 1% and gradually increasing, is automatically deducted through the tax system. So if you lose your job or your income drops, your repayments drop too. There's no collections agency calling you, no monthly stress. But here's the catch. While Australia doesn't charge traditional interest, it does index the loan to inflation. That means your debt increases each year based on the Consumer Price Index. In normal years, that might be 1 to 3%, but in high inflation years, like recently, indexation jumped significantly, which surprised many borrowers when their debt increased by thousands in a single year. So while Australia's system is generally considered more forgiving, the debt still grows if inflation rises. Now, let's compare the emotional reality. In the U.S., student loans can feel heavy. Many borrowers delay buying homes, starting families, or saving for retirement because of monthly loan payments. Some people are still paying loans into their 40s and 50s. Student debt has become a political issue, with debates around loan forgiveness and repayment reforms happening regularly. In Australia, while student debt exists, it's generally less stressful because repayments adjust to income, but graduates can still carry debts of $20,000 to $50,000 AUD depending on their degree, and because repayments are income-based, some people carry the balance for decades. So what should you actually consider before taking a student loan in either country? First, understand the total cost of your degree. not just tuition, but living expenses, textbooks, housing, transportation. Many students underestimate this. Second, think about expected income after graduation. A medical or engineering degree may justify higher debt because of higher earning potential, but if your expected salary is modest, high debt can become a burden. Third, understand the repayment structure in your country. In the U.S., learn about income-driven repayment plans, deferment, and loan forgiveness programs. In Australia, understand how indexation works and when repayments start. Fourth, avoid borrowing more than necessary. If you can work part-time, apply for scholarships, live at home for a while, or choose a more affordable institution, it can reduce long-term pressure. And here's something no one tells you clearly. Student loans are not good or bad. They are tools. If they help you increase your earning potential and open doors, they can be worth it. But if taken without planning, they can quietly limit your financial freedom for years. Now, let's address a common myth. Some people say student debt is normal. Everyone has it. That mindset can be dangerous. Just because something is common doesn't mean you shouldn't understand it deeply. You're signing a financial contract that could follow you for decades. Read it, research it, ask questions. And if you're already in debt, don't panic. Focus on increasing income, budgeting smartly, and understanding your repayment options. In the U.S., refinancing or switching to income-driven plans may help. In Australia, voluntary repayments can reduce indexation impact if you're financially stable. Education is powerful. A degree can increase lifetime earnings significantly, but the financing method matters as much as the qualification itself. If you're watching this video before choosing a university, take this seriously. If you're already in the system, manage it wisely. And if you're a parent, have honest conversations about money before signing anything. Because the goal isn't just to graduate, it's to graduate with options. If this video helped you understand student loans better, especially the real differences between Australia and the US, then make sure you like this video, share it with someone who needs this information, and subscribe to the channel for more honest, clear breakdowns of money, education, and real-world decisions that affect your future. See you in the next video.